Hey there, everyone. Today on the Final Bar, another upside follow-through day for the S&P 500, pushing above that crucial 4350 level. That's a neckline we're going to talk about in a minute here. Breadth conditions improving. The McClellan Oscillator bullish percent indexes giving a buy signal. Also, Doug Ramsey of the Leuthold Group will be joining us from Minneapolis, Minnesota. Why do small caps matter here? Ladies and gentlemen, this is the Final Bar. Hey everyone, Dave Keller here at StockCharts.com. Welcome to the Final Bar. Thank you so much for joining us every weekday after the close for our show. We have a great guest today, Doug Ramsey of the Leuthold Group. We're looking at some of the longer term charts earlier before we went live here, thinking about that relationship between the short-term corrective move we've been in and now a bit of a bounce here, and what sort of long-term versus short-term signals we can start to tease out. It's so interesting as you see conditions deteriorating August into September. You see a lot of weakness with a lot of stocks that have been leading so strongly going into, really the end of the third quarter, starting to come off, or in the third quarter, rotating lower. Now we're in the seasonal part of the year where you often have major bottoms. November and December actually tend to be pretty strong. So betting on a bit of a reversal here between now and year end, the calendar would tell you that's probably a decent bet. I couldn't help but notice our friends at the Stock Traders Almanac, Jeff Hirsch and team, just issued a buy signal using their MACD indicator just this weekend. So, overall, you're seeing a bit of a rotation back to the upside. What does this mean for the overall market environment? Let's get to the charts in our market recap, see what sort of details we can tease out. Before we get to the charts, I do want to let you know about a poll we had recently. We always have a poll going on our social media accounts, so make sure you follow us anywhere you see Stock Charts TV. And make sure you subscribe to our YouTube channel as well while you're here. We asked you recently, where will Alphabet be 1 month from today? At least 10% higher, at least 10% lower, or somewhere in the middle. Now, this is the first time we've asked one of these kind of questions recently and had more bulls than bears. If you notice from our polls, we're often asking about the S&P, we're asking about major stocks, and just asking this question about where do you see them in the next month? And it's a really interesting sentiment gauge overall. This is the first time in a while now that we've asked a question like this and have had bulls far outnumbering bears. About 75% said higher between now and a month from now, and only 25% of you saying, down, just any level down from current levels. Let's look at a chart of the stock Alphabet. GOOGL is the ticker that we're using here, and I just put a quick annotation showing you 10% up and 10% down. If we would get a 10% rally above current levels, that would take us to around 152, 152.50 is kind of where the line is playing out for me, depending on where you measure it. That would take us back to basically exceed the highs from the end of 2021, beginning of 2022. 10% lower will get us to around 125. Now, that would just briefly undercut the lows, the most recent swing lows from August and September. And what's interesting is, I think charts like Alphabet are most notable in the fact that they haven't broken down yet, right? They've actually made higher lows. And on this pullback here in September, when a lot of stocks sort of broke down and just kept going, right? Broke down through the 50-day and then kept retracing lower. Alphabet actually held that level of support, now retesting previous swing highs. So an interesting question, 10% would actually keep us in the range between those 21 highs and the most recent swing lows. Below that would be pretty disruptive here. I would say the chance of us going another 10% lower, probably not very high for a chart like Alphabet that has been such a strong performer, particularly on a relative basis, so I'll eliminate that one. I don't see it going another 10% higher, although that's seeming more and more reasonable as we have this last couple of weeks of making basically a higher high every trading day over the last 2.5 weeks. I'd probably go with the second most popular answer and say between 0 and 10% higher. A 10% gain, let's say Alphabet gets up to 150. What does that do to our major benchmarks if other FANG stocks are equally as strong over the next month? What does that do setting us up for mid-November over the final 6 months of the year? And what would that mean about earnings season, which really starts in earnest at the end of this week? This is where we can start to get some potential catalysts for names like Alphabet to gap higher or gap lower. So earnings, I think, will very much still be in play for charts like Alphabet and many others. Great responses there. Thanks so much for answering our poll. Make sure you watch out for our next one. Let's get to the market recap. As I mentioned, the S&P up about 0.5%, finishing just below 4360, we'll call it. And that 4350 level is pretty important. We've talked about that one Last week on our shows there, and by the way, wanted to thank you so much, Miss Schneider, stepping in to give a market recap yesterday for the final bar. So much appreciated. Miss is awesome. Did a really good job with it. Well, last week on the shows, we talked about that neckline and breaking down through 43.50. With today's rally after yesterday's push higher, we're actually getting back above that neckline, which I would say puts a big question mark on the whole breakdown head and shoulders top retracing much further down. We regained the neckline, and that's one of those early warnings that maybe it's not as distributive as you may have expected. Mid caps and small caps both down about 1%, so almost doubling the up day of the S&P 500 large cap index. The Nasdaq, of course, doing just fine as well. The only red on this front page is the VIX, which has come down from pushing above 20 at one point last week to now being just above 17. So we've seen a lessening of volatility. The VIX never really pushed above that crucial 20 level, sort of remained just below it, and now again pulling back once again here. So low volatility, stocks drifting higher. That's kind of classic bullish behavior, not bear market behavior, to be certain. Bond markets were closed yesterday, and of course, we've got quite the geopolitical risk situation building in the Middle East. For now, what's the impact on the equity markets? Minimal would be my general way of describing it. The things that come to mind when you have this sort of issue, particularly geographically in the Middle East, where crude oil is, of course, top of mind. When you think of the economics of the region, crude oil prices number one. Things like gold and safe havens and inflation hedges would be another one, and just interest rates, right? In the bond markets, did you see a flight to safety? Do you see markets, sort of taking, interpreting greater risk of a conflict becoming a bigger issue that all of a sudden draws more and more economies into the potential impact? We talked about that with the Russian and Ukraine crisis right as it began, and again, it sort of has had impacts at times, certainly sometimes more than others. For now, you're certainly seeing the bond markets pop higher, and I think it's certainly in some way related to what we've learned with situation in the Middle East. For today, interest rates moving lower across the curve, so the short end to the long end all coming down. The 10-year yield down about 140 basis points. It takes us to just below we'll call it 466. The long bond yield around 483. Now, these are levels that were just teasing 5%. Or just looking like they were going to push above there. Not quite getting there, now coming off a bit as the bond markets are rallying, again, off a fairly low level, so let's be clear on that as well. Commodities, a bit of a mixed bag here. You see gold prices down slightly. Gold actually bounced pretty well, end of last week into the beginning of this week, lightening up just slightly today. Silver prices and copper prices down a bit as well. Crude oil prices, I mentioned, coming off a bit, down about 0.5% using the USO today. Finally, cryptocurrencies, for the most part in the red. You're seeing Bitcoin sort of rotate lower. This was Monday into Tuesday, sort of drifting to the downside. Bitcoin currently below 27,400, and that's down about 0.8%. Ether prices down about 1% from yesterday, and well below that 1,600 level, which is a level I've often mentioned. We're sort of teasing that 1,600 levels, not breaking below there. So a bit of a risk-off move overall from when we last did our show end of last week. Finishing off here with sectors, there was a lot of movement today because earlier in the day it was, things like technology felt like we're having a bit better of a day than by the end. By the close, utilities actually finished up in the driver's seat, up 1.3%. Consumer discretionary, the XLY, up 1.1%. Materials about a similar amount. Tesla had a pretty decent day, and that's helping boost the XLY, which obviously a big exposure to Amazon, Tesla, Home Depot, and Home Depot and Ice Bounce as well. On the downside, none of the S&P sectors finishing in the red. Energy, technology, real estate, all down about 1/3%, up about 1/3% or less to finish up the bottom performers for the day. Let's go to the daily chart of the S&P 500, see how things played out. And this is what I was mentioning. Yesterday, really Friday's session was when we came back and tested that trend line from the October low and the March low on the S&P. We broke down through that a couple weeks ago. And, when I'm looking at the chart of the S&P 500, things that certainly have caused me to have a much more cautious perspective, certainly in the short term, breaking down through the neckline of this clearly defined head and shoulders top, breaking down through this trend line that we've been talking about for months now, finally being violated to the downside. But what's interesting is for now, the 200-day is held, and that's what we've mentioned a number of times, right? You have to have that line in the sand, that sort of that level that as long as we hold it, things just aren't getting that bad. We break below it, things are getting that bad. For me, that 200-day moving average around 4,200 is kind of the level. It also lined up with the 38.2% retracement of this overall move from the October low to the July peak. Also lines up with the February high. That 4,200 level is one we talked about a lot back here in the first and second quarter, watching when it finally broke higher. So we basically retested that level of resistance from above, and for now the market is saying that level is holding just fine. We're now back above the neckline, and I think that's an interesting development. Certainly if you follow this head and shoulders top, the minimum measurement goes down to around 40.70. Now, all bets are off if you get back above the neckline. That's one of those basic stops that I think is built into a head and shoulders topping pattern, right? You break down and you want to, retesting the neckline is totally fine, but getting back above there is usually not a great sign for, the signal that we had previously. Now we close above there today. We actually went quite a bit higher, but settled in to pull back a little bit off the highs through the course of the trading day today. I'd love to see if we get follow through tomorrow. So I think on Wednesday's session, do we keep holding that neckline? Currently around 43.50. That now becomes an important level in my mind. 43.50 as a short-term floor. Does that hold or not? We break below there, then I think we're right back to the distributive pattern. But for now, I see the sort of general trend as bouncing off of the 200-day, maybe retesting a trend line off of the highs. So I don't draw a lot of trend lines on the chart here day to day, but I feel myself doing it. So here we go. So I'm going to draw a trend line off of the high from July. That lines up pretty well with the high from late August and early September. We hold below that, and this is still a downtrend of lower highs. We break above there, all of a sudden this starts to change a little bit. So again, I still think a very much an open question for the S&P, as much as we try to get a good read on the short-term position. I think it's a fluid situation. Now, let's add a little bit more color to this discussion by looking at some of the breadth indicators. Now, last week we talked about breadth indicators that had gotten so negative, right? And the McClellan oscillator remaining below zero, the bullish percent index going lower and lower, advanced decline lines rotating lower. If you look today, we close back above that zero level. Now, sometimes we'll get a head fake, and that's happened a number of times in these corrective phases. Most recently, second week in September, we broke for one day back above the zero line and then came back below. So, worth noting for me, this is sort of like the flag is now raised. We look to see tomorrow if we remain above that zero line. And if so, what this is telling you, this indicator is based on the advanced decline data. It's really looking at the change in the advanced decline data is the way I would simply do it, is based on moving averages of the AD lines. So back above zero basically means that we're starting to see a bullish rotation in the short-term picture of the advanced decline data. Basically, if you look at the green shaded areas, that's when the indicator has been above zero. You can see that's when the big moves to the upside have happened most recently. We've also talked about the bullish percent index. This is looking at 500 point and figure charts and basically saying what percent of the S&P 500 members have a bullish point and figure signal at any given point. And the opposite would be, of course, the bearish reading. We got below 30% about a week ago, and then just yesterday into today have now broken back above this 30% level, what we'll call an oversold level. Look back at these previous green shaded areas. That's when we entered the oversold area and then came back above there. And you can see it pretty much identifies most of the major bottoms that we've had over the last year and a half or so. So that's why when the bullish percent index gets below zero, when it starts to get down toward this level, it tells me we're now in a downtrend. Now I'm looking for the sign that that downtrend is potentially over. I think we're seeing that signal here today with the bullish percent index popping back above that 30% level. What else can we look at? The VIX here, I'll show you very quickly here to finish off our market recap. Just a couple charts. Again, just like the S&P holding that 200-day moving average, I think that's a key takeaway in terms of the long-term trends still being healthy. The fact that the VIX did not break above 20 during this corrective period, I think also could be a telling sign, right? The real bear case for stocks would be the S&P blowing down through 4,200, the VIX spiking above 20. That would be sort of a waterfall decline, everyone getting defensive, investors getting nervous kind of reading. The VIX never getting above 20 and now starting to come off as a lot of stocks that have pulled back are now starting to bounce. It just tells me things aren't getting that bad yet. I'm not saying that we can't get below 4,200. That certainly could happen, but I'm saying for now, I'm not seeing those conditions that seem tell me that's a likely outcome for now, right? Certainly for this week, until we see things start to change again. Let's finish off looking at a couple individual names here. We highlighted what we'll call is a consolidation pattern, really a coil pattern for Tesla. This is obviously a big weight in the XLY. And so when Tesla is doing well, that certainly seems to help things out. This is that coil pattern that I'm talking about: lower highs, higher lows. The reason why I'm going to highlight this chart, we're sort of testing the upper boundary. I put a YouTube video on my channel called Market Misbehavior on Friday, looking at Tesla along with two other stocks with some compelling patterns. What happens with a coil pattern is you're waiting to see which way it breaks. We've now bounced off the lower boundary. We're testing the upper boundary. Do we see a break above that upper boundary? If so, that could indicate further upside for a chart like Tesla. I'm also interested to note that in stocks like Enphase, these are names that have been beaten down quite a bit. I'm thinking of the Starbuckses and other Disneys and other names that have been in established downtrends. One of the things I look for as a leading indicator is a bullish momentum divergence. And what that means is prices going lower, but the momentum indicator like the RSI starting to slope higher. I would argue we're seeing that with Enphase making lower lows August, September, October. The RSI making higher lows August, September, now into October. Now, that doesn't guarantee a bottom, but when I see the stock bouncing up 5%, testing the 50-day moving average after this period of a bullish divergence, it tells me buyers are starting to come in and buy in on the weakness in the price year to date, and really started just before there. Do we see an upside follow through? That would be the expectation I would be looking for on a chart like that. Finally, and again, not to pound the table too much on beaten down names starting to revert higher, but just like the bullish percent index became oversold and then rotated back above, I'm starting to see that with the stocks like Home Depot as well. Home Depot rotating lower, really stalling out on a retest of the previous highs around 330, 340. That happened in August and September. We then rotated lower, back below the 200-day moving average. But now we're in the range of this sort of support area from March, April, May. We're kind of down in that area. The RSI becomes oversold again, and we bounce back higher. So the way that I tend to think of a chart like this, short term, is it bullish that we were oversold and now came out of that region? Definitely. Longer term, what would you need to see to be more constructive? And that's where you need to think about the short-term rally, the contrarian rally off of the lows versus a long-term reversal. For me, it's the momentum more improving. It's the relative strength improving. It's putting higher lows and higher highs, not just bouncing off of a very beaten down level. But for now, stocks like Home Depot and Tesla really finding some renewed signs of strength here this week. That's it for our market recap. I'm going to bring on today's guest, Doug Ramsey, here in a moment. Before we do that, I just want to make a couple quick announcements. First off, we're going to do another live Q&A tomorrow on Wednesday, 1 p.m. Eastern, 10 a.m. Pacific. We'll be set up in our studio here at Stock Charts TV. We'll have a couple charts queued up, and then it'll be driven all by our chat. So I would encourage you to join us. If you've not joined us for our live Q&A before, just go to our YouTube channel. At the top, there's a little live button. You can find it, set a notification so you don't miss it tomorrow, 1 p.m. Eastern, 10 a.m. Pacific. You may have noticed, by the way, with our live versions of this show, we do have the chat room open. We're going to be using that more and more, really going into next week. We'll hope to use that live chat more and more often. So feel free to use it, chat with each other, get some questions for me and our guests, and we'll start to incorporate them more and more into our discussions on the final bar. Let's continue on with today's guest, Doug Ramsey. Doug is the Chief Investment Officer at the Leuthold Group, coming to us live from Minneapolis, Minnesota. Doug, good to see you. How are you these days, okay?
I'm doing well. How are you, Dave?
We're hanging in there. A lot to talk about, I feel like, and this market just continues to provide new things to review and reflect on. The last time you were on, we talked a little bit about small caps, and you sent a chart or two to sort of get this discussion started. We're looking at the Russell 2000 here. Talk to us about the look here of the last 5 to 6 years.
Well, longer term view here. And, part of the idea here maybe is just to challenge the idea that, if we're headed for a soft landing, don't you think that this Russell 2000, these cyclically sensitive stocks would be acting better than what they have? From a long-term perspective, at last week's lows, the Russell undercut the high that it made back in August of 2018. I mean, just remarkable when you think about all of the stimulus that's been thrown at the economy and the markets in the last 5 years plus. You had the restart of QE in the fall of 2019, obviously all the stimulus associated with COVID, and then it really has shifted from excessive monetary stimulus. That's gone away, but now we're running a deficit that's over 8% of GDP. So to me, it's just remarkable that, with the Fed balance sheet over this 5 years up 90%, federal spending and federal debt both up over 50%. M2 is up about that amount. The CPI is up 22%. It's just remarkable that small caps have not responded to that. Now, on the bright side for value-oriented investors, the valuations today on the Russell 2000, like the average Russell 2000 stock, are down about 40% from where you could have bought these stocks a little over 5 years ago. So there's a good value case, I think, to be made on a longer term basis. Now, if we do sink into recession over the next 6 to 12 months, I mean, these stocks are going to participate, but the relative downside might be less than you would think in that scenario, just because they've sat out for so long.
Yeah, your second chart, Doug, really talks about what has usually happened to small caps in a major advance versus what's happening now. How does this cycle look different to you?
Well, for one, we've broadened our definition here. When I say major advance, I mean, this is a technicality, but it's a little broader group than a bull market. So like a major advance would be something like after that decline it was a 19.8% decline in 2018, we would consider that a major decline. So a bounce off of that, or a bounce off of the 1998 low, which again was a 19% and change. So not like a full-blown recession-oriented bull market, but like a major advance. So just comparing the move in the Russell to those past major advances, here we are. We're just 2 days away from the first anniversary of the bear market low in the S&P 500. So we're just benching all the moves in the Russell 2000 against that, and it's far and away the worst move that we've seen off of a major decline. I mean, the average decline, David, in the first year off of a bear market low for the Russell is more than 50%. And, if we have a couple bad days tomorrow and Thursday, we're going to be down in the first year, just unprecedented. So I kind of take that as an economic tell. And maybe, we've talked about how well these mega caps, I mean, the S&P and the NASDAQ have shrugged off the higher interest rates, but it also says that this tightening of liquidity really is only floating a few boats, and obviously most people are in those boats, and the Russell 2000 stocks and the broader universe is not.
This has been a tough one, I think, for probably for you and I and others. If you've been a part of previous cycles where it's one of those sort of go-to bull market approaches, is you buy small, risk on in the bullish phase. It just hasn't worked this time around very well at all. Now, one of the things we've talked about a lot on the show, Doug, is our breadth conditions and just how much they deteriorated really August into September and October. We're looking at the AD, the net advancers minus decliners for the S&P 500. Talk to us about this chart and what it tells you about the recent dynamics here.
Sure. I don't want to overplay this. This is a shorter term concept. But for years, we've monitored this. It's 10-day average net advances on the S&P 500. So you take advances minus decliners, and then just take a 10-day moving average of that. And what we observed, and by the way, when we're doing these sorts of studies, we like to use roundish numbers just to avoid the idea that we're curve fitting. But what we learned was that if this 10-day breadth oscillator on the S&P 500 can bottom between -100 and -150, then usually that's like buyable weakness. But when you undercut that -150 reading, and I'm seeing that your numbers show that at the low, the S&P low last Tuesday, we exactly touched negative 150. Now, I used the Bloomberg numbers and it showed negative 151. So in that case, that would be a signal. The signal is that's a super oversold internal condition. And super oversold can be dangerous. Not all the time, but it does set up what sometimes has been a pre-crash condition. And we've got all of the data back to 1957 for S&P 500 breadth. There have been 59 of these signals, like the initial signals. We don't count the little wiggles that might happen a few days later. But the remarkable statistic is that when you get a downside internal thrust that strong, that in 53 out of the prior 59 cases, you had further downside. And it usually occurs over the next 2 to 4 weeks. So this is just a little window here where risks of downside are elevated. I mean, you could buy, some puts on your portfolio rather than shorting or, liquidating everything. But it is sort of a warning. And so think of it as a reverse breadth thrust. I mean, it's not as good just because of the underlying tendency of the market to go up. But the average undercut has been 7.1% below the market level, accompanying the initial super oversold reading. And by the way, I mean, on the positive side, we've had some strong days now. This short-term window for further weakness, it would be rescinded or it would be closed if we get up to a mild overbought condition on this oscillator up to plus 100. So that would close the window. So when I say the average additional downside is 7.1%, that's any time leading up to this oscillator crossing back plus 100. So yeah, if we have 2 or 3 more days like this that we've seen in the last 3 trading days, that signal could well be rescinded. But it's something concerning, and here we are in a month of what's typically been troubling for the stock market, leading into what is often a good year-end window.
Yeah, Octobers can be challenging. There's no doubt. And this indicator in particular, I appreciate you introducing this one to our viewers. Thanks for that one, Doug. Your last one, we're talking about the NASDAQ and new 52-week highs, new 52-week lows. I can't help but notice a lot more red than green on this chart recently. Talk to us about what this means for you here.
It's really been remarkable because NASDAQ, and the NASDAQ 100 in particular, has been in leadership mode now for quite a while. And I guess this is one, and maybe I just justify insights like this to justify my hand entering of some of these data points. But what was striking with last week's, these are the weekly 52-week new highs and new lows on the NASDAQ, as we printed, I think it was like 962 last week. And what struck me, I mean, I just saw that, boy, that's a huge number. So I went back, and that number is actually greater than the number of new lows that we printed in the week end December 30th, 2022. And December 30th itself was the daily closing low for the NASDAQ composite. Just remarkable. I mean, now we've got NASDAQ with these last couple strong days up 30% year to date. How are you printing more new lows on NASDAQ than you were at the absolute bear market low? It's a pretty remarkable thing, just showing to what extent this narrowing has happened within even the leadership index within the market.
This is so super helpful, Doug. We only have about a minute left, but I know before we went live, we were talking about the major trend index, which I've followed with from Leuthold for quite some time. You mentioned how it just recently had rotated from to a bearish reading. What do you see overall when you look at the major trend index, and what would you attribute that, I guess, decline in the conditions? What is standing out to you when you review the data here?
Okay, very quick background, major trend index was negative throughout most of 2022. Correctly, we got some strong technical signals, and it was mainly the technical stuff back in January that pushed it into neutral territory, and then it's oscillated within neutral territory all year up until last week. And it was this internal weakness that I've been talking about that finally drove down that technical category. I should mention the technicals, as much as I'm sort of wringing my hands over this stuff, the technical category just now slipped to neutral. What pulled the overall major trend reading down to negative is that valuations have been propped up by these mega cap stocks. So cap weighted valuations for the S&P are still quite high. And then the monetary conditions with contracting money supply, the Fed in QT mode, inverted yield curve, rate hikes, and now this bond yield blitz. I mean, our monetary work has remained quite negative. So we've reduced, we kind of front ran, so to speak, this negative MTI reading. We cut some equity exposure from our tactical funds back on September 5th at higher levels. And then with the weakness we saw in breadth, we increased equity hedges again to bring our net equity exposure in our tactical funds down to 44%. Typical range of 30 to 70. So we're not as bearish as we could be. As I mentioned, there's some values to be had out there if you're outside the S&P 500. But I would not foresee a scenario where we went down to that minimum, no matter how bad looking the charts got, because a lot of damage has been done to the broad market.
There's no doubt about that, Doug. Listen, it is great to see you. Thanks for sharing some charts and some insights with us. Stay safe, be well there in Minneapolis. We'll talk to you again soon.
All right. Thanks, Dave. Great to see you.
That's Doug Ramsey. Doug's the Chief Investment Officer at the Leuthold Group. Steve Leuthold, really a pioneer in terms of market strategy, the primary trend index that, or the major trend index, that Doug mentioned, something I know a lot of institutions have followed for years, really combines technical work with other disciplines, which I always found so valuable to think about the price trends, the momentum versus valuations versus macro conditions. So we're really helpful to get an update on what Doug Ramsey is seeing. Thanks so much, Doug, from the Leuthold Group in Minneapolis. We've got to wrap the show, folks, and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. I mentioned the breadth data has come beaten down. A couple of Doug's charts really, I think, supported that discussion of the weakening breadth conditions. But as always, when you see conditions get really negative, I'm always looking for that mean reversion move to the upside. And I have to tell you, reviewing the charts again this morning, 2 of these, the McClellan Oscillator and the Bullish Percent Index, have now rotated back to what are pretty classic buy signals. I remain super skeptical of this market, and I will tell you, my big picture, non-chart macro hat tells me that there's a lot of causes for concern. The seasonal tendencies certainly tell you we're probably entering into a relatively strong period for stocks. And a lot of these breadth conditions that have been very negative may be starting to turn a little bit higher. The Bullish Percent Index on the S&P 500 really grabbed my attention when I was reviewing the charts this morning, giving a very similar reversal pattern to what we've seen at some of the more significant bottoms that we've had in bull phases and in bear phases. So that is where we're at today. Chart number 2, I've been asked a lot recently in some interviews just last couple days about geopolitical developments in the Middle East, what that might mean for the markets. And the general areas where I would tend to look would be the commodity space, particularly crude oil, but also bonds, right? I'm thinking about interest rates. Now, the interest rate environment has been an area of focus for a lot of reasons, for inflation, inflationary pressures, the Fed and their hawkish tone, the possibility or the likelihood of additional rate hikes between now and year end at the next couple Fed meetings. For now, bond prices are bouncing this week. The TLT came out of a pretty oversold level here at the beginning of October. Coming out of that oversold level, what's interesting is you're seeing a lot of charts like Home Depot and others that have been beaten down, now starting to break back above those oversold levels. I'm watching that on the TLT, but let's be clear. I think the larger trend in bond prices is still clearly lower, of a pattern of lower lows and lower highs. We might just be getting that bounce off of a new low as opposed to a big reversal pattern. I don't see near enough data to support a major reversal higher in bond prices or a reversal lower in rates. But in the short term, we're certainly seeing that sign of mean reversion. Finally, I am always looking for charts that satisfy those leading indicators. You know, a lot of the technical toolkit that we talk about on the final bar that I use in my own work are really trend following indicators, right? They're lagging indicators. That's not a negative sign. That's not to the detriment of the indicator. That's by design, right? You don't get a signal until the trend has reversed. And there's a lot of benefit to riding the bulk of trends to the upside and the downside. But I also have a part of the technical toolkit I like to follow that are more leading indicators, looking for potential reversal points before they happen, looking for similar conditions to previous bottoming phases. I can't help but notice on a stock like InPhase, we've been making lower lows over the last 6 weeks on stronger momentum. We were oversold back here in August. We are not oversold anymore on the most recent new low here in early October. We're gapping higher today. We're trading higher by about 5%, regaining the 50-day moving average, or at least trading above it. But overall, I see this as a bullish momentum divergence. I'd watch to see if we can put in a higher low. Does that confirm a rotation from a bearish phase to maybe more of an accumulation phase? Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the final bar. Thanks for tuning into our live show. If you are doing so, make sure you check out our other live broadcasts, including our live Q&A coming up Wednesday at 1 p.m. Eastern. Special thank you to Doug Ramsey of the Leuthold Group joining us from Minneapolis, Minnesota. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.